Everybody, Steven Sitkowski here. Welcome to this week's edition of Market Insights. Hope you had a great Father's Day weekend for all the dads out there. It is June 17th. You know, we are embarking on the longest day of the year. I think it's happening this year on the 20th. I think is the summer solstice. It was weird, it was 9 o'clock last night. I was looking outside going, there's still some daylight. I want you to know that everything we do here is for educational and informational purposes only. It's not intended as investment advice. So what to keep an eye on this week? Well, today we had the Empire State Manufacturing Survey. I've got some comments about that in a little bit. The bottom line is manufacturing in New York is definitely picking up, so that's good news. Tomorrow we've got retail sales coming out, kind of a proxy for the economy, and then a whole bunch of Fed speak. On Wednesday, the market is closed for Juneteenth Day. On Thursday, as always, we have the initial jobless claims, housing starts, and then on Friday, we have the flash PMI for services and manufacturing and U.S. leading economic indicators, which are still indicating negative. We'll see what happens on that. Relatively slow news week. There's last week's heat map. Apple had a great week. NVIDIA had a great week. Broadcom did a 10-for-1 split, up 25%. Tesla up, Home Depot up. There were a lot of stocks in the red, although because some of the stocks in the green were heavily in the green, we had a slight up week. There's your 1-year heat map. As always, led by NVIDIA, up 209% for the year. Amazon up 43%, Alphabet 40%, Meta 76%, Lilly 94%. A lot of companies have had really good years, and then you got Tesla down 29%. Market breadth last week, not bad. 240 stocks hit new highs on the New York Stock Exchange compared to 158 with new lows. On the NASDAQ, 315 new highs, 409 new lows. That's not terrific. Some of the big winners, Broadcom, Skyworks, Qorvo, Oracle, Arista, Hewlett-Packard, Apple, Micron Technology, GE Vernova, and Supermicro Computers led the way. CAPI came in a flat for May. Look at that. No increase in prices month to month. Awesome. CPI year over year came in at 3.3, down from 3.4. So that was good news. Consumer confidence is down. We've got some cracks in the fundamentals of the economy. Unemployment is moving up some. GDP has been revised downwards. Delinquencies on credit cards and other forms of debt are up. PEs by sector. So the S&P 500 is trading at 21.1 times their annual earnings, which are offering the most bang for the buck right now. Energy trading at 11.6 times earnings, plus paying a nice dividend. That's tough to argue with. Financials, 14.8, REIT, 16.3, communication services, 18.9. And then up there at the top, technology is at 30.4. So tech and consumer discretionary are above the averages for the S&P. Everything else is below. Relative value. So when you look at, breaking down PEs, the expensive one is Tesla. That's why their stock's going down. We have NVIDIA, also expensive, but their earnings are gigantic, followed by Microsoft, Amazon. Kind of at the low end of this is Alphabet and Meta represent relatively good buys. It is a lopsided market for sure. You look at returns, it's Amazon, Apple, Microsoft, Google, and NVIDIA up 32%. And then the S&P year-to-date, 13%. Equal weighted on the S&P, every stock counted the same, just up 5%. Percentage of stocks trading above their 50-day moving average on the S&P 500, 44%. Mid cap, 39%. We're still waiting for small cap to move, just 36%. Stock buybacks. So we have record buybacks this year, which is good for existing shareholders. And where are the buybacks happening? Financials number one, tech number two, and then it all drops off after that. We love stock splits. So understand that when a stock splits, the company does not become more valuable. What happens is the company gets pushed front and center and everybody's talking about it. And then in theory, as you have splits, more people can afford the stock. We just saw Broadcom do a 10-for-1 split. We saw NVIDIA do a 10-for-1 split. But, if you look out since 1980, a stock split over the next 12 months increases the value of that company by 25.4%. So you got to take advantage of that. No doubt. Investor sentiment hanging in there, 44.6% bullish compared to last week at 39%. We're down to 25.7% bearish. Fed probabilities of a rate cut, slight probability in July, legitimate probability in September, and the market's really banking that by November, if not in November, we will have our first rate cut. Sector returns, how those looked? Well, over the last year, the S&P is up 22.96. Tech leading the way, big shocker there. Communication services following, and then financials, which is number 3, is actually less than the S&P. And then you get a big drop off. Industrials, consumer discretionary was way up here at the top. That has shifted a lot. And the defensive sectors, healthcare, materials, energy, staples, utilities, and REITs, they haven't fared well at all. Take a look at the charts, see what they've got to say. Let's look at the S&P 500. Looks terrific. And look at that. Spent almost the entirety of this 6-month time span above its 50-day moving average, which is bullish. And we're well clear of that 50-day right now. So SP 500 looks great. How about the Qs? Fabulous. Qs are running. Man, technology has just been killing it. And how about the Russell 2000? Not so much. Yep. So it has been, a large cap market by and large. And I'm super excited to share with you. So my partner and I issue for our Inner Circle members Trade Ideas of the Week. Thought I'd show you how we've done for 2024. So from the beginning of the year, we have closed 69 trades. We're still in a number of trades. Average return per trade, almost 18% in a little more than 18 days. So we've been profitable on 67 out of 69 trades. And we're averaging almost 1% per day. Can I guarantee the second half of the year is going to look like the first? No. We were profitable on 93.1% of trade ideas last year. So for those of you who have any question in your mind, does this stuff work? And again, some of you aren't real familiar with rates of return. This isn't 17.9% for the year. It is 17.93% in 18 days. Now, if you were to throw that into a financial calculator, it would blow up. If we had done half that well, it would have been an extraordinary rate of return. You know, on average in the stock market, it'll take you 2 years to make 18% historically. We're doing it in 18 days. Any of you serious about trying to figure out how to get to retirement, how to be able to create income and cash flow for yourself? If you're not learning what we're teaching, tell you what, you're just flat doing it the hard way. So we are certainly happy to have you back again this week, and I'll keep updating this track record week by week. Then you'll be able to have the latest and the greatest. All right. Well, we will see you next week. Until then, bye for now.